All right, let's go ahead and begin. My name is Tim Parks. Thanks for joining me today. We'll be doing a presentation on behalf of Davis Shilkin PC on the election implications, some proposed tax changes and strategies in reaction to those changes. Davis Shilkin PC is an estate planning firm. We practice in the area of estate planning and estate and trust settlement. And so I encourage you, if you have any questions or comments or concerns, to reach out to our offices. You'll notice that the number to reach us is on the bottom corner of each of the slides today, so you can reach out to us. All right, so our agenda for today, in order to compare Biden's proposed tax plan, we will be looking at the current estate and GST tax laws so that we can contrast those. I know that there is still uncertainty as to the election results, but it seems like it is. The results indicate that Biden will be the next president. And so we are going to be discussing his proposed tax plan. We're also going to be looking at advanced gifting and clients who are wanting to take advantage of advanced gifting, some things to be aware of with regards to the anti-clawback regulations and what that means. And then for those who may be closer to or may have a taxable estate in the near future, we're going to be looking at some tax planning strategies that have come up. These tax planning strategies are almost all abbreviated there. You have SLATs, a spousal lifetime access trust. You have irrevocable life insurance trust, grantor retained annuity trust, family limited partnerships, and private foundations. And then at the end, we will be hosting a live question answer session for those of us who are able to join us live. So this is our agenda today. So let's go ahead and take a look at some of the current tax laws. First of all, right now, the personal tax exemption, the personal estate tax exemption for each person will be increased to $11.7 million per person. And that's for 2021. It's 2020 right now. We're still finishing up this year. And so right now it's $11.58 million per person. But since that's indexed for inflation, it goes up to $11.7 million. And that's a change that was brought about under the Tax Cuts and Jobs Act of 2017. This effectively doubles for married couples. So you would have over $23 million sheltered from estate taxes for a married couple, and that is through portability. Now, that's not available for generation skipping transfer tax. So this exemption amount applies to estate taxes. It also applies to gift taxes. If you're gifting over the annual gift exclusion amount of $15,000 per person per year, then you would be eating away at your lifetime gifting exemption amount. And your lifetime gifting exemption amount right now is $11.7 million. Well, it will be $11.7 million for 2021. That 11.7 also applies to generation skipping tax exclusion, but that does not double for married couples. One big asterisk at the bottom of the screen there is that these changes, or the Tax Cuts and Jobs Act, will sunset at the end of December 31, 2025. So January 1, 2026, the new tax implications will revert back to what they were prior to the Tax Cuts and Jobs Act, and that was $5.49 million per person, and so it effectively be cut in half, and that also is indexed for inflation. That's if no new laws are passed at all. Now we're going to look at Biden's proposed tax plan in just a second, but if no new laws are passed, then it is scheduled to sunset at the end of December 31, 2025. So those are the current estate taxes. For individuals, income tax rates and tax brackets, there are still 7 different tax brackets for an individual, and this is based on the amount of income that's earned. I don't have the income numbers up there for you. They do change year to year, and that's going to be something that you'd want to check with your CPA on as you file your taxes. However, we do look at trust and estate tax return and tax rates. There's 4 tax brackets for a trust and estate, and so we refer to that as a compressed tax bracket. And I'll show you in the next slide what that looks like as far as the income that a trust is allowed to receive before it pays the highest tax bracket. So for the taxable year 2021, if trust income falls into one of these categories, then this is how it's taxed. If it's not over $2,650, 10% of it would be taxable income. If it's over $2,650, but not over $9,550, then there is a tax of $265 plus 24% of anything over the $2,650. If it's over $9,550, but under $13,050, then you pay a tax of $1,921 plus 35%. And then notice how low this number is. If it's anything over $13,050, you pay $3,146 in taxes plus 37% of the excess over 13. So we refer to that as a compressed tax bracket. And anytime a trust receives income, it's, if possible, it's almost always advisable to distribute that income out in the taxable year to the beneficiary so that the beneficiary pays the taxes at their individual tax rate and not, as you can see, at this compressed tax rate that's on the screen. And this applies to grantor trusts, often abbreviated RLT, which stands for revocable living trusts. So that's the trust and estates tax rates. For 2021, the boosted standard deduction is $25,100 for married individuals filing jointly, $18,800 for heads of household filers, and then $12,550 for other taxpayers. Because the standard deduction is so high, it is almost not worth it at all to itemize deductions and to just instead take the standard deduction. And then the exemption amount is reduced to zero for personal exemptions. We also have qualified business income, the 20% deduction for qualified business income under Section 199A. And this benefits sole proprietorships, partnerships, LLCs, S corporations, rental, real estate, and trust and estates. So you're able to deduct the qualified business income there. Okay, so this next part, as we move into Biden's proposed tax plan, I think it is important to understand that nothing is set in stone and there is still a lot of uncertainty. However, we are trying to be proactive. We're not just trying to scare people into reactions. We're trying to be proactive in looking at what may be coming about and some steps to take now with the estate tax exemption being as high as it is. There's being more flexibility. We're trying to be proactive in those endeavors, but I do understand we've had some concerns in the past where people have said that this is just purely speculation. It's not certain what's going to be taking place, but we are trying to watch it closely and stay informed and keep our clients and other professionals informed as well. So I understand that. And with that qualifier, let's take a look at Biden's proposed tax plan. His proposed tax plan would reduce the estate tax exemption amount from $11.7 million per person to $3.5 million per person, or if you double that, $7 million for married couples. And any excess would be taxed at 50%. Right now, the federal estate tax rate is around 37%, which is fairly high. It would be increased to 50% under Biden's proposed tax plan. Under Biden's tax plan, individual income tax rates at the highest rate would be raised to 39%, so about a 2% increase there, nothing hugely significant. But they would be adding in the Obamacare tax and a Social Security payroll tax as well. And so if you add those together, income earners who are earning over $400,000 would have an applicable tax rate of 49.6%. So that's for individual income taxes. Biden has also proposed, so right now capital gains, the capital gains rate that you would pay is about a 15% federal rate and a 5% state rate here in Colorado. And if your capital gains is over the $445,850, then it's taxed at 20%. Biden has proposed that anything over $1 million in capital gains would be taxed at 39.6%. And there would also be an Obamacare tax of 3.8%. So that has to do with capital gains. He's also proposed eliminating the like-kind exchange for real estate. Like-kind exchange has been eliminated for a lot of other categories, but you can still do a like-kind exchange for real estate to delay or defer capital gains, and Biden's proposed tax plan would remove that. And then it would also repeal the 199A deductions available for real estate as well. And it would increase the corporate tax rate to 28%. I think right now it's about 21%. So it would increase the effective corporate tax rate to 28%. So these are some of the changes. And again, we recognize that depending on the control of the Senate, it could take some time or it may not happen at all. But it has also been proposed that any of these changes would be implemented retroactively to start January 1 of 2021, so this coming January, which means that the window for any advanced tax planning for people who have higher net worths would be short. It would be a close window that they would need to be focused on and be cautious about. So that is sort of a summary. Until we have more definitive answers, we're not able to go into too much more detail, but that is what has been proposed. Because of that, there is an inclination for people with higher net worths to want to take advantage of the higher gifting exemption amount and do advanced gifting right now. The idea being that right now the estate tax exemption amount and the lifetime gifting exemption amount is $11.7 million per person. And that may go back down, or it may be early repealed, or it may be reduced to 3.5. We're not sure, but we do know that at the end of 2025, it will sunset back to what it was before. And so clients are talking about, well, is there a way to gift under the higher gifting exemption amount now, so that when it sunsets, we've taken advantage of that and gotten some of our assets out of our taxable estate. However, there is a misconception. Clients often incorrectly believe that gifts made prior to 2026 above the annual gift exclusion use up the temporary higher applicable amount first, which we'll refer to the bonus exemption amount, instead of using up the base exemption amount. Now, this does get a little bit into the weeds, but here's a diagram that hopefully will be helpful. You can see the box on the yellow there is illustrating the bonus exemption amount, and that's the higher amount that we have right now in 2020. So before 2026 or early repeal, the bonus exemption amount is $11.58 million, and that's per person. However, after 2025, or if it is repealed early, it could go back down to what it was before under what we're calling the base exemption amount. So this is to illustrate how it could be decreased and how it will be decreased if no new laws are passed. All right, so to take advantage of the bonus exemption amount, clients ask about gifting the bonus exemption amount now before this law sunsets or before it is repealed. However, to use the exemption amount, the bonus exemption amount, you actually would need to gift more than the base exemption amount. Otherwise, you're not taking advantage of the bonus exemption amount. And don't worry, I have a diagram to explain this as well. But what the IRS clarified in example 1 under the regulations is that it does not use up the bonus exemption amount first when you give a gift away. Instead, any gifts that you make over the annual exclusion use up the base exemption amount. It is a bottom-up calculation instead of a top-down calculation. So here's a way to illustrate this that hopefully will clarify some things. So again, you have the column on the left there is before 2026, and that's the $11.58 million. Now, in this example, the client decides that they want to give away $3 million as a gift to try to use up the bonus exemption amount. However, as you can see by the gray shading there, their $3 million gift does not use up the bonus exemption amount. Instead, it's eating away at the base exemption amount so that when the law sunsets or if it is early repealed, they've already used up $3 million of what they would have had under the new law, under the sunset. So they haven't taken advantage of the bonus exemption amount. Instead, that amount just goes away. and they haven't really improved their tax situation at all. In fact, they've used up their base exemption amount. This next example illustrates the effect of giving an $8 million gift, and that's illustrated by the gray shaded lines. So in this example, the client has decided to give away $8 million of assets, and there you can see that it did eat away at a portion of the bonus exemption amount under the yellow box, so that after the law sunsets, or if it's early repealed, they have taken advantage of that, and that higher amount that they've gifted will not be clawed back in to their estate for tax purposes. And this is referred to the anti-clawback regulations that were approved and implemented. So if someone gifts over the base exemption amount and they use up some of their bonus exemption amount, they're not going to be penalized for that later when the amount sunsets and is reduced. And that is a way to take advantage of the higher gifting amount. So that's something to be aware of when it comes to advanced gifting. Okay, so now that we've sort of discussed that foundational piece and Biden's proposed tax plan, we then look at some advanced planning strategies. And this is a situation where it is not a one size fits all or a one size applies to all. It's going to depend entirely upon someone's circumstances, their goals, their objectives, their assets, and things of that nature. So it would be important as you're going through this, if you saw something that was of interest to you, to make sure that you review it with someone who is able to understand your situation and your context and arrive at the optimal strategy. So your optimal tax strategy depends on your circumstances. It may depend on if you have a taxable estate. It depends on if you have other specific goals that you could accomplish with tax strategies, such as avoiding probate with trust planning. And it could be that you have charitable goals. It could be that you have family succession planning goals, whatever it may be. But we are advising people to be cautious about the wait and see approach in the event that laws are implemented retroactively and you've lost that opportunity. So that is something to be careful about with the wait and see approach. All right, so what are some strategies that someone may be interested in? The first one is called a SLAT, or a spousal lifetime access trust. This is an irrevocable trust that a spouse can set up for the benefit of another spouse and usually descendants. So it's an irrevocable trust that you are putting your assets in for the benefit of your spouse or your descendants. Usually when we refer to a revocable living trust, that is a self-settled trust, and that's to be distinguished from this. This is not a revocable trust. This is an irrevocable trust. And we'll talk more about the floating spouse provisions in just a second. And the grantor in this situation, the person setting up the trust, the grantor, can retain the power to fire and hire trustees. Now, why would someone set up a SLAT? Well, the idea behind a SLAT is twofold: asset protection and estate tax savings. So if you set up a SLAT with what we call, a completed gift, in that situation, those assets are not considered a part of your estate for the purposes of estate taxes at your death if you've drafted it correctly and set it up correctly. So that's why you would do a completed gift. However, if you're just in a profession that may have a high likelihood of lawsuits, or if you're trying to accomplish creditor protection, then you could set up what's called an incomplete gift SLAT. There, although you would have the asset protection, you would not necessarily be able to remove that from your taxable estate. Now, in order for it to be a completed gift, the grantor cannot retain a power of appointment to redirect the shares or a power to veto distributions. And that's different from an incomplete gift. And an incomplete gift that's one where the grantor does have a lifetime and testamentary power of appointment so that they can redistribute the assets as they see fit through the trust to a limited number of beneficiaries. And they also have veto power over distributions out of the trust for the beneficiaries. So retaining those powers makes it an incomplete gift. For the purposes of our conversation today, we're going to focus on doing it as a completed gift because of the estate tax savings advantage. So if someone is motivated by trying to set up a plan for tax savings, then they would want to do a completed gifting slat. And here's just some provisions that cause this to not be treated or not to be included in someone's estate. It is important to note that for income tax purposes, two spouses are generally treated as one, but for estate tax purposes, this is not the case. So we can distinguish the amounts. However, if any one of these sections is violated, it can cause the asset to be included. So if you have what's called 2036 retained interests, 2037 transfer with retained reversionary interests, it could be that you've transferred it with a retained power to alter, amend, or revoke, or if you've retained the general power of appointment. Those sections, if you haven't drafted it correctly, they could cause the asset to be included in your estate for tax purposes. What happens if you set up a slat and you have need of the assets that are in the slat? How would you go about assessing those? So let's say that I set up a slat for my spouse and suddenly I run out of money and I need those assets. Well, again, our focus is on a completed gifting slat. In that situation, the slat can make distributions to my spouse, and my spouse may then decide to care for me. It could be that the slat grants a loan to me, or my spouse exercises the power of appointment to me, the settlor. So those are some ways to access the slat. Now, what about for clients who are living with a significant other but are not married, or perhaps they're single and they don't have anyone in their life that they are married to or interested in? Well, in this situation, because it is a completed gift, that's one where you would want to be very careful about considering this before you set up the slat. And that's why the very bottom point there, it says this is a very important upfront consideration. However, early on, we mentioned the floating spouse provision, and that stands for the principle that you can generically refer to the slat as the beneficiary being your spouse and not someone's particular name, which means that as long as you have a spouse, they qualify as the beneficiary. Even if you were to get divorced or remarried, as long as you get remarried and have a spouse, that will still meet the requirements of that term spouse. We call that a floating spouse. And so that works out okay as long as you are comfortable with the idea that this has to be for the benefit of a spouse and potentially descendants. Some other considerations to think about. You can have life insurance in a slat. However, we're going to look at, when we get to life insurance, something called incidence of ownership. And if you violate the 2042 incidence of ownership, then that could cause the life insurance proceeds to be clawed back into your estate. It's also important to be aware of what's called the reciprocal trust doctrine. In this situation, two spouses have set up the exact same slat for each other. So I set up a slat for my wife, she's the beneficiary, and my kids are also the beneficiaries. And she sets up a slat for me, I'm the beneficiary, and our kids are also the beneficiaries. Well, in that situation, we have created mere plans of each other, or reciprocal trust for each other. And under this Supreme Court case, the United States versus the Estate of Grace, you can't violate the reciprocal trust doctrine, or it will not accomplish your estate tax planning goals. And so the underlying portion there is key. Does it leave the settlors in approximately the same economic position as if they had created trust naming themselves as the life beneficiaries? So that is the principle behind the reciprocal trust doctrine. To accomplish a non-reciprocal slat, what you would need to do may be as simple as saying, in my case, I could say that my wife is the beneficiary and my kids are the remainder beneficiaries. And my wife could set one up for just our kids, not for me. Well, that's a different economical position. And so those are non-reciprocal slats, and you would want to be aware of that. And then I think we mentioned this briefly already, that if you get divorced, as long as you have this floating spouse provisions, you're going to be okay, but you will have to get remarried so that you have a spouse who can benefit from that trust. Okay, so that is our discussion on SLATs. And again, I encourage you, if you have questions, to reach out to us, and we should have an opportunity for questions at the end for live questions. Another estate planning advanced technique is by using what's called an irrevocable life insurance trust, often abbreviated an ILIT. And these were a lot more commonplace back when estate tax exemption amount was as low as it was in the early 2000s. I think it was around $600,000 per person, which is pretty easy to meet nowadays. And so a lot of people would come up with the use of an ILIT. Now, an ILIT is one of those tools that you can pair well with another strategy, another goal. So the saying, killing two birds with one stone, that's the idea behind this. So reasons for life insurance may be income replacement. If I'm the income earner, or if my wife is the income earner and she has a life insurance policy and dies, then that income can be replaced. It may also be that you need asset liquidity at death to pay off bills, including taxes. It could be that you've given loans out or helped your children out with business endeavors in a way that causes you want to equalize the inheritance, and you can do that with life insurance. It may be that you're trying to accomplish wealth replacement, or you need a business succession plan in the event that one of the owners or co-owners of a business dies. In that situation, a life insurance policy can help with the buy-sell agreements. So these are some other reasons for life insurance that you can pair with advanced tax planning. So, so that is the discussion on ILITs. Now we get to the estate taxation of insurance. These are things that could cause the insurance to be included or clawed back into the decedent's estate if the insurance is owned by the decedent. If the proceeds are payable to the estate, in other words, there's not a valid beneficiary. If the decedent transferred the policy within 3 years of death. If the proceeds are mandated to pay the obligations of the estate. Or, and I mentioned this earlier, if the decedent has what's called incidents of ownership. And there's some bullet point list of the things that would qualify as incidents of ownership: the right to assign the policy, the right to revoke the assignment, to change the beneficiaries, to surrender the policy, or to pledge the policy for a third-party loan. Those are all considered incidents of ownerships. And these are things that you want to be careful about avoiding if you are trying to accomplish your advanced tax planning. So this is a pretty technical area. Obviously, anything with advanced planning, we would consider that a technical area for drafting purposes, but this is one that you want to be careful about. Now, for forming an irrevocable life insurance trust, we're going to see the steps here as they come up. First, you would establish the trust. You would draft the trust and you would sign it executing the trust. Secondly, the trustee would apply for an ID number, a tax ID number for the trust, because it is an irrevocable trust. It's a separate entity for purposes of taxes. The trustee would then sign the application for life insurance. They would open a checking account on behalf of the trust. The trust maker would give a gift to the trustee, and usually that gift represents the premiums to pay for the policy. The trustee then gives notice to the beneficiary of their present interest in that gift. We'll get to that in just a second. And then if the beneficiaries don't exercise their right to the premiums or to the gift, then the trustee uses the gift to pay for the premiums on the insurance. So that is the steps in creating and funding an irrevocable life insurance trust. Now, here's some advantages to setting up an ILIT. First of all, the proceeds of the insurance are held by the trustee and can be managed by someone who is a professional management team. The grantor can determine the terms under which the beneficiary will receive the proceeds. So you can establish what the proceeds are to be used for and under what terms the beneficiary will receive the proceeds. Properly drafting an ILIT can remove those insurance proceeds from the estate of the grantor and spouse. And if there's a need for access, then terms may allow specified access to proceeds by a surviving spouse. And properly drafted ILET may facilitate generation skipping transfer tax planning as well. So these are some of the benefits. Contrast that with some of the disadvantages. First of all, you have the cost of preparing the trust documents. You may have trustee fees if you have a professional team managing your trust. You have the special permission in the trust for the trust to qualify for the annual gift tax exclusion. If the insured dies within 3 years of the transfer of an existing policy to an ILET, the insurance proceeds will be pulled back into the decedent's estate. So you do have that 3-year period that you would need to survive. And then if permanent insurance policy is transferred to an ILET, the client may lose the flexibility and access to the policy's cash surrender value. So these are some things to be aware of in moving forward with the objective of an ILET. And then the goal for an ILET is to remove the policy from the insurer's gross estate at the least possible gift tax without diminishing the available unified credit amount. And so there's a need to qualify for the annual gift tax exclusion when you're paying those premiums. And then absent special provisions created by a present interest, a gift to a trust is a non-present interest gift and does not qualify for the annual gift exclusion. We're going to talk about that in just a second here with the Crummy v. Commissioner. So this was also a case that's where we get the term crummy notices from. If you've set up an ILET, your trustee is supposed to be giving crummy notices to the beneficiary every time you gift to the ILET. So when a grantor pays for the premiums, they usually don't pay for them directly. They give that to the trustee. The trustee then has to give a crummy notice to the beneficiaries, letting them know that they have a present interest in this gift. And then if the beneficiary doesn't exercise that withdrawal right, then the trustee uses that gift to pay the premium. So going through those steps, that is important for maintaining your ILET, and that is called crummy notices. This is where you get it from. A couple of other things to be aware of. You would not want to insure, you wouldn't want the insured to be the trustee. The grantor who serves as trustee will be deemed to have, insured grantor who serves as trustee will be deemed to have incidents of ownership. And it's usually discouraged to have the spouse as the insured as well. It's not automatic grounds for imputing the trustee's incidents of ownership, but it does create additional risk. And then a spouse can serve as trustee, but must not have a general power of appointment over proceeds. And this precludes the spouse from using the proceeds to discharge their obligations. And you can't have a broad power to distribute income or principal to an insured spouse or minor child. So this is, again, a technical area, something to be careful about in moving forward with this before you try to set something like this up. That's ILETs. Another one that we do with some frequency is what's called a grantor retained annuity trust, or a GRAT. This is also an irrevocable trust, and it is a trust that you would create for a specific term of years, always identified as the term. And that term is based on your life expectancy, interest rates, growth rates, and things that you have to factor into the purposes and the goal behind the trust. During the term, you will receive from the trust an annual or more frequent annuity payment expressed as either a fixed dollar amount or a fixed percentage of the initial fair market value of the property transferred into the trust. The trust can pay the annuity to you either in cash or in kind based on the value of the trust property. And at the end of the term, the remaining principal of the trust, if any, will be distributed to or held in further trust for the beneficiaries you've specified in the GRAT. I think it's helpful to see a picture of this as well to understand how this works. So in this diagram, the client gives a gift to the GRAT, and the present interest, the present value of the gift is then amortized over the period of the term. And that is paid back to the client. The annuity payments are made to the client annually for a term of years. However, depending on what the asset is, it's usually an asset that we expect to appreciate in value. Stocks, business interests, whatever it may be. At the end of the term, whatever is remaining or however much it has appreciated, that amount is then either stays in a trust or for the beneficiaries, or it is distributed to the beneficiaries. So this is a great tool to use to get things that are appreciating in value, get that appreciation out of your estate now without triggering the gift tax implications, because you are paying it back to yourself over a period of time. Your gift to the GRAT is a taxable gift that will utilize some portion of your remaining lifetime gift tax exemption. So if you're wanting to take advantage of that now while the gift tax exemption amount is so high, now may be the best time to do that. However, the amount of the gift, so the amount of the gift is equal to the fair market value of the property transferred to the GRAT, less the actuary value of the annuity payments that you will receive. So you are getting those payments back each year, and the idea is that that is close to the present value interest that you've transferred to the GRAT. The actuary value of the annuity payment is based on several factors, including the IRS interest rates for the month in which the GRAT is funded, the length of the term, the size of the annuity payment as a percentage, and the size of the annuity payment as a percentage of the initial fair market value of the GRAT asset, or the payout rate. This is a pretty technical technique to use. We actually have software that we use to back into the calculations to find out. You can plug in growth rates, the IRS rates, you can plug in what the asset value is now, and life expectancy, and then based on the formula, it produces the optimal results. So definitely something that is pretty technical, and you want to run the calculations on this prior to moving forward with anything like this. All right, so that is the use of a grantor retained annuity trust, or a GRAT. Some other tools that people use, and this is just going to depend on your particular situation, what you're trying to accomplish, is the use of a family limited partnership. In this situation, you can establish a partnership, a family partnership with your children or your loved ones, and because of the limited nature of the interest in the partnership, you can discount those interests. A pretty aggressive discount would be anywhere up from 35 to 40% of the total interest. And that's based on the partnership agreement, the right to transfer ownership, voting versus non-voting shares, and majority interest. If a parent wants to bring a child on board now, but they want to retain control, they can do so with the number of shares that they issue and by issuing non-voting or voting shares. So there's ways to retain control. It's a good way to get the children involved in the family business before you pass that on to them, and to assess their level of responsibility. So it just depends on your goals, but this is a technique that people will use. The other one, and this is going to be similar to the family limited partnership, but more charitably inclined, is to set up a private foundation. A private foundation can qualify as a nonprofit, and then you can set up the charitable goals as you see fit. You can bring in loved ones to help manage the private foundation, and that would apply if you had charitable goals. This might be a good way to do it to mitigate some of your tax consequences as well. All right, some final things to consider. I've said this repeatedly, but your circumstances and goals will determine the optimal approach to take. We do believe that if you have concerns, or if you would be close to the estate tax exemption amount under Biden's proposed tax plan, now may be a very relevant time for you to review to make sure that you understand how it applies to you. We offer no obligation review meetings with anyone who wants to come in. We don't charge anything for that unless you decide to hire us to do some work. And so it's really a pretty risk-free endeavor on your part. And so we encourage you to reach out to our offices and to schedule something today if this is something that you have concerns about. Alternatively, if you would just like to schedule a phone call or something like that with myself or one of the other attorneys here, we would be more than happy to. We do ask that you give us a call to schedule that so that we know that we will be available to reach you when the time comes. Thank you very much for joining us today. This concludes our presentation. And if you're with us live today, we will have a time for questions and answers as we stop this recording.